Morning, everyone. Thanks for joining us today. We're going to be going over some really exciting plans with EquiTrust. I know we'll be joined by Jason Goodrich here shortly. He's our regional rep from EquiTrust. Does a great job on their marketing side, and I know EquiTrust has been having a great year on their programs on their annuity side, and we've seen some really good results on their strategies out there. So I know Jason's going to be discussing some of that information with us. Again, this is Matt Tour. I'm the marketing specialist here at IMES on the annuity end. Been here a number of years, kind of know what's going on in the market these days. So anything you've got questions on along the way, you can get those typed in. I'll be glad to get those answered for you. Anything you've got questions on afterwards, I'll be giving everyone a call that did attend or today's webinar. So anything comes up you can think about afterwards, I'll be glad to go over those with you. Got some great producer perks based on production the first 6 months of being contracted. You can get some really good business development tools with different seminar systems, radio shows, workshops, a lot of good stuff you can choose from. We also have different cash incentives based on the different levels and some other items of choice. You can go with Ritz-Carlton trips. You can go with a complete television package based on the $1 million level. So a lot of good stuff there you can choose from based on production with IMES and for new producers. We also have our referral producer program. You can earn some nice incentives by referring other agents to IMES, and you get a nice little override on their business. You also get a nice upfront cash incentive based on referring agents to IMES. We also have our marketing reimbursement account. You can get your marketing expenses reimbursed based on levels of production. You have a nice little side account that builds up when you write business with IMES on the index annuity side. A great way for us to help pay for your expenses when it comes to advertising, and anything you submit, we reimburse half the cost. So if you submitted a $2,000 bill, we'll reimburse up to $1,000 based on your account balance. We'd also have a fantastic back office support team here. We got a great new business department, helps you with all of your production. When it comes in-house, we review it, make sure everything is complete. We can go ahead and forward those to the home office. We help with the home office and getting everything taken care of for getting money transfers, suitability done, and we follow that case through all the way to the end. It gets issued and you get paid. Obviously, the quicker it gets issued, the quicker you get paid, the happier everyone is. So a great combination there. Got a great creative team here also. They do a great job on putting together pieces for advertising and other elements. So keep that in mind. We also have some great quoting systems on our website, and you can ask for quotes from a lot of the different marketers on the life and annuity side. We're glad to get those done for you. And we've got a great contracting department. If you want to get licensed up with EquiTrust or any other carrier, they can help you do that online through our Assurance Bay connection. That's the platform we use. We've really seen a big switch to online applications. I know Firelight Technologies is what we utilize. I know that EquiTrust is part of that system. And the good thing about using Firelight, once you submit the application online, it actually goes into our CRM. We are aware that the case was put into the system, and then we follow up on it on the timely manner. Of course, when you're using the Firelight system, the applications typically are much more complete, and they go through the channels a lot quicker by using the online system. So definitely keep that in mind when you're looking at applications. Once you've used it once, it really comes in handy, and you're able to really maximize your time in the field by spending less time on filling out the applications when you can do those electronically. As I mentioned, we have a great service team on the creative side. Got a great group of individuals that can help with any marketing you want to do on maybe website development, maybe you want to do some emails, do some social media advertising. They can help you across the board. Maybe you want to redo your logo or redo your colors on your company. They can help you out with all that. So they've got a great system they've developed on that side. And if you're doing business through IMES, we do take care of most of those costs. And it's a great way to maximize your advertising needs by using that creative system. As I mentioned, we do have a good website you can utilize. We've got a lot of good information on there. You can do quotes. You can look up a lot of different programs online. Maybe you want to look at an AM Best report on a company. Maybe you want to look up some tax information or look up the latest interest rates on the annuity end. I know we're seeing a lot of changes on interest on multi-year rate guarantee annuities, on indexed annuities, a lot of cap changes, participation rate changes. So we keep that system updated as possible. I know we use a system that every day gets updated on the website. So if you look at the latest 5-year rate in Pennsylvania, what the best rates are, you can pull them up. You can see exactly who's paying the most. If you want to look for the best income based on the scenario for a client, you can pull that up. It's going to show that. So a lot of great information you can pull off that website. So definitely keep that handy. We also have a great client software program called the Retirement Analyzer, and it's a full turnkey system you can utilize with clients, and it's got a great report it generates. You can really take a look at kind of where clients stand now for retirement, what they need to do between now and maybe the next 10 to 15 years to maximize their retirement years. And it's really a nice program. I know that we have Marcus Solar and David Corwin, two really good individuals to speak to on the Retirement Analyzer. We have a lot of agents that use that on a regular basis, and really a nice program to use. We've got our wealth management team here, and I know we've got a great group of people in that department. And if you do have interest in taking a look at what the wealth management side has to offer, I'm going to launch a quick poll here in regards to that. If you do have interest in getting some additional information on the wealth management side of the business, I know we've seen that area really grow the last number of years. We started this about 2 years ago, and I know we have well over $100 million in assets under management on that side. So really it's a big area, especially for agents that need to cover all aspects of the business. And that really comes in handy. You hate to refer someone to somebody else and end up losing that client. If you can handle all sides of the business, you tend to be able to keep clients on board and to keep them happy with both sides of the insurance and the security side at the same time. So that's something you have some interest in. And we've got some great platforms out there. If you want to figure out how you can get your Series 65 passed, they can help you out with all that information. There's a guide you would go through and help you get ready for that testing. So definitely something to take advantage of. I'll leave this open for about another 20 seconds or so, but if you do have interest, I know Charles Hiring Jr., Mike, Zach, you can talk to anybody in the wealth management side. They'd be glad to show you the ropes and kind of go over some details on what's being offered on that side of it. Go ahead and get this closed up here real quick. Get moving along here. I know we also offer a real nice trip. We do on about every 18 months. We've been doing these, and our next top producer summit trip is going to be to the Mediterranean. It's going to be a cruise around Italy with stops in Croatia, Greece, and some other locations. It's about a week trip. Should be a fantastic voyage, as you say, on the Mediterranean there in Europe. So should be a really nice time had by all. 4.5 million points to qualify. It's a 19-month qualification, started last December, runs through June of 2022. So you have over a year to qualify for this trip left. So if you're on your way, and congratulations, we've got some people already qualified for it, but it's going to be a great trip, good time had by all. So keep that in mind. We also have a Life and Annuity Academy. We'll be announcing some dates here shortly. It's going to be in the beginning of October. And as soon as we have the information on that finalized, we'll go ahead and send some emails out. I know they're very successful with these academies in the past. We have not been able to do one for a while due to the pandemic, but we're looking at doing one in October. As soon as we have the location and dates finalized, we'll go ahead and do some emails. Great learning experience to pick up information on sales ideas. We bring in some great speakers. We bring in very successful agents that do go over what they do in the field to create more business. If you have interest in that, mark off yes. We'll go ahead and add you to the list of interested parties. It's typically all expense paid. We take care of your travel, you take care of your lodging, your food, your drink. Everything's taken care of. We bring in, if we do them in Omaha, we bring in a number of different carriers that go over their strengths, what they have available, go over some sales ideas, and it's really a great way to spend 2 days picking up information. We see a big increase in production from those agents that do attend these meetings. We typically bring in between 35 and 45 agents to each one of these, and it's a good way to obviously, discuss with other agents what they're having success with in the field, some of the best sales techniques they're using. So it's really definitely worth your time to attend one of these meetings. So if you have interest in that, mark off yes. We'll go ahead and keep this poll open for about another 30 seconds or so, and we'll go ahead and get it switched over to Jason here shortly, and he'll be discussing the ins and outs of the EquiTrust portfolio, going over some sales ideas, some stuff they've come up with here recently. I know they've got some very strong index strategies are uncapped with the Mark V, which is just added to a couple products. Also, their Barclays Index, really a strong combination. But appreciate everybody voting on this poll here. We'll go ahead and get that closed up. And we also have some presence on Facebook and LinkedIn. And we do have sites on both sides. If you have interest in following us on Facebook, you can go to that facebook.com IMS Inc. address, or LinkedIn. We have a LinkedIn address there if you want to follow us on LinkedIn. I know we do some special programs on that, so if that's something you have some interest in, definitely get on board for that. And at this point, I'm going to go ahead and make Jason the presenter here. It's going to go over to his information on the presentation here. So good morning, Jason. I'm glad you could join us this morning. It's always good to have you on board here on a Wednesday morning. Appreciate your time with us here today.
Better unmute myself first. Thank you very much, Matt. Good morning, everyone. First off, just let me thank everybody for taking time away from your busy schedules to join me for the webinar this morning. I know your time is very valuable and really do appreciate you giving me some of it this morning. As Matt said, my name is Jason Goodrich, and I'm the National Accounts Senior Manager with EquiTrust Life Insurance Company. The focus of this morning's webinar will first off be a quick overview and positioning of the 4 EquiTrust index annuities. Then we're going to spend a little bit of time talking about the importance of diversification and why I think our products work very well for that. And then we'll close by showing you a couple of point-of-sale client pieces that are very popular with our producers. And lastly, what I think is a very unique sales idea on converting a portion of your client's traditional IRA into a Roth IRA, but doing so without the client having to pay anything out of pocket to cover the taxes associated with that conversion. So it's a pretty unique idea I want to share with everyone. Excuse me, I'll try to keep everything at a fairly high level though, and hopefully keep the presentation to around 30 minutes, but definitely want to leave some time at the end if you have any questions at all. Lastly, let me just thank Matt and all the great folks over at IMS. IMS has been a tremendous partner with EquiTrust since the very beginning of EquiTrust, and really do appreciate all they do for us. With that, let's go ahead and get started. First thing I want to do is kind of get into the index annuities we offer and get kind of a high-level overview and positioning of the products. About a little over 2 years ago, we did something a little different in the industry, in that we kind of reduced our offering of index annuities. At one point, we had 9 index annuities, and a couple of years ago, we reduced it to 4. So we kind of consolidated everything and made stuff simpler and easier to understand and follow, but at the same time, we made ourselves much more competitive too. So we shrunk everything down, made it simple and more competitive at the same time. And as I talk through the 4 products, I think what you'll see is there's kind of 3 major niches we have, or three areas where we really stick out from a competitive standpoint. The first one of those would be premium bonuses. So two of our 4 products have premium bonuses. And with the EquiTrust premium bonuses, they are upfront bonuses. So there's no vesting schedule. They're immediately part of the account value, death benefit, including the surrender value and everything. So it's a little unique in the industry today that there's not some sort of recapture or vesting schedule on the bonus. We still keep ours very easy to understand and just, completely upfront. Second niche, I'd say, an area where we've seen the biggest growth is on our 2 accumulation-focused products. I'll talk more about this in a little bit, but we have 2 products, the market value and the market 7. One's a 10-year product, one's a 7-year product. The whole goal of those 2 products is really growth, right? Trying to maximize the amount you can grow within fixed index annuity. And we'll come back to that in a little bit. And then the third niche is with our market 10 bonus product, which is our bonus product, but it also has a unique feature that has a no cost return of premium. So a built-in return of premium rider where the client can get their money back at any time. Kind of 3 areas where we really stick out from a product standpoint would be premium bonuses, strong accumulation, and then return of premium. I do want to mention too, just briefly, excuse me, Matt had mentioned previously that we had a couple of nice custom indexes that we rolled out just a little bit over a year ago. So the first one is the Barclays Focus 50. This is exclusive to EquiTrust. So it's only available on the EquiTrust index annuities. It is available on all four of our index annuities. And really what it does is, it's really simple, I think, as far as vol control indices go. It just allocates between 3 things. It looks at the 50 lowest volatility U.S. stocks. It looks at 4 different lengths of U.S. Treasuries and cash. So that's all it's using to determine the outcome. Now, we found a lot of producers and a lot of clients really like this because when you look at the 50 low volatility stocks that it uses, and it can change from month to month, these are the brand names, right? These are the names that everybody knows. These are what I call the big, boring companies. And when there's a lot of volatility, people like big, boring companies. So some of the companies that make up the 50 low vol stocks would be like Coca-Cola, Pepsi, Costco, Campbell Soup, Johnson & Johnson, Waste Management, Walmart. So you get the idea. These are the companies that that your clients know, and have been around for a long, long time. So like I said, that is available on all 4 of our index products, and I'll show you the rates on that in a minute. And then Matt also mentioned the S&P Mark V. We also launched this one a little bit over a year ago. It was launched on just 2 of our products, but as Matt mentioned, we did just add it to our 2 bonus products. So this strategy is now available on all 4 of the index annuities we're talking about today. This one's been around for a little while. There are some other carriers that have this. As Matt mentioned, this performed very well. The history on it's very strong. And once again, it's a very simple one to follow. It's just using these components right here. It's using equities, commodities, fixed income, and cash. And once again, it's something a client's going to have an easier time understanding than some of the other vol control out there. Because for equities, it's using the S&P 500, which people are familiar with. For commodities, it's using gold. And the reason it uses gold is that's a good hedge against inflation, if they're concerned about inflation. And the third thing for the fixed income is they're using the 10-year treasury, which a lot of people are familiar with. So very simple to understand and historically performed very well, which you'll see in a little bit. Okay, let's get into the products briefly here. The first product I'm going to talk about is the Market Power Bonus. This really is kind of the flagship product for EquiTrust. It is the first index annuity we rolled out in, I believe it was February of 2004. Since that time, in those 17 years, it's been our #1 product every year but one. So it's always been a popular product for us. Just quickly on it, it's either a 14-year or a 10-year design, depends on your state. And I'll show you a map in a second so you know which version you have. The big thing with it is a 10% premium bonus, right? So you put $100,000 in, they immediately have $110,000 as part of their value. Once again, no vesting on it. And pays 8% commission if it's a 14-year contract and 7% if it's a 10-year. As far as who it's appropriate for, well, it's going to be appropriate for anybody that would benefit from a premium bonus. I'll talk about that in a second, a little bit about who might benefit from a premium bonus. So I'll come back to that in just a minute here. Here's the map I talked about. So these darker green states, I guess, if you're in one of these states, you have the 14-year version of this. contract. Okay, if you're in one of these other states with the lighter green, then you have the 10-year version. The gray states are the 3 states that we don't have the product in. It's in every other state. So, for instance, if you're in Texas, you have a 10-year product that pays a 10% upfront premium bonus without vesting. So, it's very popular in all the states, but these 10-year states, I think it's a great option. As far as the rates, obviously there's a premium bonus, so you're going to see rates that maybe aren't as high as you'd see on a non-premium bonus product. But just going down here, looking at the Focus 50, you have a 40% par. On the 1 year, a 55% par. On the 2 year, then with the Mark 5, it's a 45% par. So you're looking at illustrated rates in the 3.7 range. One thing I like to point out too is when you look at the Focus 50, we have fixed option costs on that. So what that means is when you look at this 40% par rate, most likely that's not going to change throughout the life of the contract much, if at all. Reason being is our option costs are not going to change on it. Plus, it's a volatility control index, so we're controlling the volatility. Because of that, we're going to have really stable option costs. And I'll talk about renewal rates in a minute, but the way we do renewal rates is we give the client the same value every year. So the option budget we have for the client it issues, the option budget we're going to have next year. And if the option costs aren't going to change, then it's going to renew at the same rate. Okay. So I think that's important to remember. And I think it's important. That's a reason why it's important to have a vol control index within any index annuity. You're right, because it gives you a lot more options at renewal too, as renewal rates may decrease. Okay, I mentioned a little bit ago about a bonus. Obviously the market power bonus is going to be attractive to somebody that's attracted to a premium bonus. So when does a premium bonus make sense? I think, a lot of people believe you should always write a non-bonus product because the caps and rates are typically going to be higher than a bonus product. And in a lot of cases, that's true. I mean, I would agree with that. In a lot of cases, it makes more sense to do a non-bonus product. But there are a lot of situations where I think it makes sense to use a premium bonus. So I just wanted to quickly list some of those. Number one is if a client has a short time horizon before accessing money from it. Okay, maybe wealth transfer. Maybe they're not insurable for life insurance. They don't want to go through underwriting. And they're using this just as a way to transfer money to their kids or grandkids. Because of the premium bonus, they put that $100,000 in, they immediately have $110,000. If they pass away 3 months later, their beneficiary is going to get the $110,000. Right, so we do have people using it for that. Number two is annuitization. You can annuitize this product after 5 years. I know a lot of folks out there do laddering strategies. So if you're planning on annuitizing in 5 years, I think it makes sense to use a product with a premium bonus to front load that contract as much as possible before annuitizing it. Then obviously income rider, it makes sense to have a premium bonus. We're not really getting into income riders today, but that makes sense in that situation. Another one I see is because of the free withdrawals. Maybe you or I know there are some folks out there that use the free withdrawal as a way to bridge Social Security. Right, so they're going to take out free withdrawals for 4 or 5 years before they turn on the Social Security. Well, if that's the case, I think it makes sense with a premium bonus product because your account value is going to be higher in the early years. And because your account value is higher in the early years, your 10% free withdrawal is going to be higher in the early years. So if they're planning on taking out withdrawals immediately after the first year, it could make sense to use a premium bonus product. Of course, recovering from an underperforming product, maybe they're just in a product that hasn't performed well, or maybe the renewal rates have dropped down to minimums. This is a way to make up, for the premium bonus is a way to make up some of that underperforming product. Low index performance, it really doesn't matter what your cap is if the index doesn't perform. Whether you have a 3% cap or a 6% cap, if the index returns 1%, the client still gets 1%. So if it's a low index environment, once again, a bonus may make sense. And lastly, kind of what we find ourselves in now is a low interest rate environment where, rates and caps just aren't that great and haven't been for a while. In that case, and maybe it makes sense to front load the contract a little more, right? Give them that upfront 10%, really put it up front since the long-term growth isn't, maybe as much as they'd like it to be. So there's just a few thoughts about when maybe a bonus would make sense or the market power bonus would make sense. Okay, the next product is the Market 10 bonus. A couple highlights on this. First off, it is a flexible premium product. And as mentioned earlier, it does have a 6% premium bonus. Now, that premium bonus is on any premium in the first 5 years. Okay, so this can work as a great option for somebody that wants to do flexible premium. Maybe they want to start it, with $5,000 of qualified money, then add, $1,000 a year or $2,000 a year to it or whatever. They could do that, and they would get the 6% bonus on that money for the first 5 years, and there is no rolling surrender charge on that. So if they add money in year 5, the surrender charge on that money is only going to be 5 more years. And as I mentioned earlier, this is the one with the return of premium rider. And what that means is just what it says. Whatever premium they put into it, they're guaranteed to get back. So if they put $100,000 in and a year later change their mind and decide they need that money back, they're guaranteed to get the full $100,000 back. This one goes age 80, 6% commission. We do not reduce commission. So it pays a full 6% commission all the way to age 80. Who's it appropriate for? Well, obviously somebody that wants the peace of mind with the return of premium. Somebody that maybe an index annuity makes a lot of sense for, but for some reason they just can't get past the surrender charge or the surrender schedule. This is a good product to pivot to because they can be put at ease because they know they can always get their money back. Another thing we see is people that have CDs. A lot of people that have one CD have multiple CDs coming due at different times. Because the bonus is good for the first 5 years, it's a good way to consolidate different accounts or CDs over several months or years or whatever into one contract and get that bonus on all the money. And lastly is Roth Conversions. I'm not going to get too deep into this, but I am aware of a lot of folks that use this as a way to gradually convert someone's IRA to a Roth IRA. Maybe they have an IRA somewhere else and they can't do partial conversions or what have you. They could send the free withdrawal amount to EquiTrust into the Market 10 bonus. We would do a in-flight conversion of that portion of the money to a Roth and then apply it to the Market 10 bonus and the premium bonus. So we actually convert to a Roth before we give them the 6% premium bonus. So the premium bonus would not be taxed in that situation. Okay, and they could do that every year. Right, for 5 years, the agent would get paid every year for 5 years. The client would be able to slowly convert their money into a Roth IRA. And at the end of the day, they'd only have one policy. Where, if you do a partial conversion, I think usually that creates new policies every time. So the client has multiple policies. That wouldn't be the case with this. I'm not going to get a lot into this today, but if you have questions about that, feel free to reach out to Matt or myself and be happy to discuss further. Okay, the rates on the Market 10. Once again, they're going to be lower because of the premium bonus and even lower than the market power bonus because of the ROP, right? But you still have a 50% on the 2-year, 40% on the Mark 5. So, but the ROP is really the big cost associated with the Market 10 bonus. Okay, that's the 2 bonus products. Let's hit the 2 index products and we'll get into some sales ideas here. The market value index is the next one. I mentioned towards the beginning that the market power bonus is our flagship product. It's been our number 1 product every year, but 1 year. That's going to change this year because the market value index is our number 1 product year to date by quite a ways. Going back over the last year from today, it's been our number 1 product. And I think mainly just because it's very simple, it's very straightforward, has strong rates, strong caps, strong renewal rate history, good commission. It's just been a good overall performer from a straight growth perspective. And once again, very simple and easy to understand. And does pay a 7% commission. You'll see here I put trail available. We do pay a 1% trail option on all 4 of our index annuities. We do see a lot of people use the trail option with the market value index because it is such a growth product. Right? And who's it appropriate for? Well, it's appropriate for anybody looking for just long-term growth. Right? Where the premium bonus, you're looking more for upfront type account value. This is more longer-term account value over the 10-year period. Here's where it is with the rates. So let's just talk about those. You can see we have a lot of different strategies on it and very, very solid rates and caps across the board. I mean, a point-to-point cap of 4.5, the point-to-point par is 30. These monthly average strategies have performed very well over the last year. We've had some huge returns on those. Then we come down here to the Focus 50. You got a 90% par in the 1 year, 120 on the 2 year. Remember what I said earlier about renewal rates on this strategy, they shouldn't change much. And with the Mark V, you got 100% par also. So I don't love to get into illustrated rates, but you're looking at an illustrated rate of I think 7.88% on this strategy. One thing I do want to point out too is that we don't subsidize our products, right? So we don't, or our strategies. Where you may see with some carriers where they take something out of one strategy to make another strategy more attractive. We don't do that. We try to keep everything as competitive as we can across the board. So you don't have to rely just on one strategy. What that does is on the anniversary, when you meet with your client, it gives them a lot more option on their anniversary to reallocate to a different strategy or move money around. Okay, and with that in mind, I kind of want to get into the diversification story because I do think it's very important to diversify between strategies, and we see a lot of people do that with this product. Let me just kind of get into that and kind of walk through a little, what we call a quilt that we put together. So let me show you. So this is on the market value index, the product we just talked about. It's going back to 2010 to 2020. Okay, so 11 years. Excuse me. And what you see on the first line here is you see the S&P raw returns for those 11 years. So in 3 of the years, there was no return. In 8 of the years, there was a positive return on the S&P 500. And here's kind of a quilt. So what you see here is we just rank each one. So the top one was the best performer in that year, all the way down to the bottom one, which was the lowest performer in that year. And they're all just color-coded, right? So the monthly cap S&P 500 is just light blue color around here. And what you see is kind of things are kind of all over the place there, as you might expect. But let me kind of focus in on a couple things. First off, here is the top performer in each year. I'm going to take out 2015 because there was no return on 2015. So in 10 of the years, there was a return in at least one of our strategies. And what you'll notice here is of the 7 strategies we have that are 1-year strategies, which we're only using the 1-year strategies on this, 5 of them were the number 1 performer in at least 1 year. So 5 of the 7 strategies would have been the best performer in a year, which I think tells the story of diversification. And the 2 that were not a top performer ever were number 2 in at least 1 year. The second best performer in at least 1 year. Okay. Next thing I point out is this. There was 3 years where the S&P did not have a return: 2011, 2015, and 2018. And we already talked about 2015. We didn't show a return in any of our indices, but in the other 2 years, we actually had returns. In 2011, the S&P was 0%, but the Mark V returned over 11. The Focus 50 returned over 9. And then the averaging strategies on the S&P 500 both had positive returns, even though the S&P did not on a point-to-point basis, right? And that's the power of averaging. I think averaging is one of the most underutilized strategies. You come over to 2018, S&P is down over 6%, but the S&P monthly average cap and the S&P monthly average par both had positive returns because of the averaging. When there's a lot of volatility in the market, which we've seen, I think it makes sense to incorporate, some of the money into an averaging strategy. Because in 2018, the Mark V and the Barclays didn't perform either. Only the averaging strategy did. So I think this also tells the diversification story and why it makes sense to diversify. Okay, what I want to show here is I blurred out all the S&P strategies. So what you see on your screen is just the Mark V and the Focus 50 1 year. Okay, and what you see is they performed very well. I mean, they've been at or near the top most of the years, right? But most of you may know this year bulk control has not performed that well. And the Mark V and the point-to-point and the Focus 50 are part of that, right? It's not been a great year for those strategies. So I want to just look at the S&P strategies, and I'll blur out the Mark V and the Barclays. So if I do that, now we're just looking at the S&P strategies. So if we take out the 2 vol control strategies, what you see is all 5 of our S&P strategies would have won in a given year, right? So they all make sense. They can all make sense to use, obviously. So I thought it was very interesting that the S&P strategies, and that goes back to what I said earlier about how we don't subsidize one strategy. We make them all competitive. They're all fully priced. And because of that, what you see is different ones performing each year, which once again is a good reason to diversify. Something else I found interesting I just point out is the monthly cap. So this is the monthly point-to-point strategy that I know a lot of people use. You can see it was the lowest performer in a lot of years, right? It's really an all or nothing strategy, it seems like. It was also the top strategy in a year with a 14, plus percent return, right? And a 13% return in another year. So I'm not saying it doesn't make sense to use it, but it's more of an all or nothing strategy where the other ones seem to me be more consistent. Okay, so what do we conclude from that? First off, I think you can't predict which strategy will perform best, right? That's what that showed when all but 2 of our strategies were the top performer in the last 11 years. Nobody can predict it. Also, if you diversify and you use averaging strategies and you use the vol control strategies, you still might see some returns in years where the S&P goes down. 2 of the 3 years the S&P went down, we had returns in S&P averaging strategies and the vol control strategies. And lastly, one thing I always like to point out is to not chase past results, right? I think we see a lot of people that just kind of move to whatever performed the best the previous year. Well, what the chart shows, that's not necessarily indicative of what's going to perform the best in next year. We do have a flyer on this. It's a producer-only flyer, but it is on our website. Obviously, me or Matt can get this over to you, but it kind of goes through the same chart I just showed you in a flyer format of showing the value of diversification. Along with that, and with the market value, I think the other thing that's really important when looking at any product, especially a accumulation product, is renewal rate integrity. We take a lot of pride at EquiTrust in our renewal rate integrity. We're very transparent. All of our index annuities, since the first one we issued, you can see all the renewal rates on our website. So you could go back to 2004, put in the issue date of March 1st, 2004 market power bonus. It would show you what that issued at and what it renewed at every single year since then. So we don't cherry pick rates. We put them all out there. So we're very transparent on that. What I always say, and then also with renewal rates, I mentioned this earlier, is we try to give the same value to the client every year, right? So we try not to change the option budget if we don't have to each year. What really drives the renewal rates is the option costs, right? Do the costs go up? If the costs go up, we can't buy as high a cap next year as we could the previous year. And we have this piece on our website also, which just runs through an example. And if you just look at the point-to-point cap here, you can see in 2008, it issued with a 6.25% cap, back when caps were a lot better. And you can see it stayed there for 3 years, and it actually went up to 6.5% through year 7. Then in year 8, it came down to 5.75, and it's come down since then, right? This shows that they're not perfect renewal rates, but the thing is can you explain the dips? And you can. I mean, in year 8, we were reinvesting in bonds at a lower rate, so our option budget shrunk at that point, right? So once again, we're very transparent on it. What I always say is we're going to raise rates when we can, and we're going to lower them when we have to. But we're always going to try to get the client the same value. We're always going to be transparent about how and why our rates change. Okay, last product, and then we'll talk about a couple sales ideas.
Yeah, I just launched a quick poll. Jason Wybrary's still on. If you want some more information on EquiTrust, mark off yes. I'd be glad to get some more information on current rates, brochures, what you may need. I also had a question come up, Jason, on trails. How many of your products offer trails? I know a number of them do. Are you seeing a lot of activity on that side these days?
Yeah, all 4 of our index annuities have trails. We see quite a bit in the market value in the market 7. Actually, we're seeing a lot in the market 7, which I'm going to talk about next. We don't see much in the bonus products just because, the long-term accumulation is not as high, as it would be on the value 7, but it is a 1% trail. So yeah, we do see, we're seeing that increase definitely.
Sure. And the 1%, that's based on their current accumulation. So if your client's not taking money out, that trail will actually go up, correct?
Yes, which is why we see a lot of it on the market value, because it's a heavy growth product, so the account values are increasing, a lot each year. So, and then their trails are increasing too.
Exactly. But yeah, we've seen more and more interest on that, especially with agents that like to have a pretty good AUM and also a good trail base. If you can earn 1% across the board on all your clients' investments, it's a pretty nice combination.
Yep.
So I noticed on that graph you had up on the strategies, it looks like, I mean, if you cover the Mark V and the Barclays with a decent percentage of your monies, you're going to see, pretty much two of the top three or top four on an annual basis. Those seem to come on at the very top on pretty much every year.
Yeah, they've been they've performed very well historically. So, like I said, this year's been a little bit of an exception, but yeah, they have. I mean, they were the top performers almost every year, or in the top four pretty much every year.
Right. Are you seeing a majority of the money's going into those accounts? Is that what you're seeing based on the no caps on those?
Yeah, I see a lot of people. I don't have the numbers in front of me here, Matt, but I see a lot of people do a mixture of the 2-year Barclays and the 1-year Mark V. And I'll talk about that in a second, why that can make sense, but from an allocation standpoint. But we still see a lot of that, but we still see a lot of S&P action too. I mean,
sure,
obviously it's everybody's preference, but my preference is to use S&P strategies as well, because as you saw there, a lot of times they were the top performer too. And in a year like this year, where the Barclays and Mark V are not performing as well, the S&P is.
Sure.
Unfortunately, we can't predict what's going to perform the best. I wish we could and make it a lot easier.
Right. No, definitely. Well, I just took the poll down so you can keep rolling along here.
Okay. One more product, and then we got a couple sales ideas we'll get into. Market 7, very much like the market value index, except it's a 7-year version. So it's really built for growth. For the 7-year design, strong commission for a 7-year product, pays 5.5% up to age 75, and then reduces at the older ages. And I will say, Matt, we have quite a bit of producers doing trail on this product as well. The market value in this product is where we see a lot of trail, because it's still a 1% trail on a 7-year product.
Yeah, I mean, if you look at 2.75 versus a 1% trail, the trail's definitely the way to go.
And who it's appropriate for, a MYGA alternative. I'll talk about this in a second. One other interesting thing about this product is it has a guaranteed accumulation value of 107%. So what that means is at the end of the 7-year surrender charge, if it is not grown by 7%, we'll automatically increase it to that. So if they put $100,000 in, and let's say at the end of 7 years, their value is $106,000, we'll automatically one-time increase that to $107,000 at that point. So basically what that means is they're guaranteed a 1% simple interest annual return at the end of 7 years. So just a nice little guaranteed feature. But as far as a MYGA alternative, let me pull this next screen. I'll talk about that. You can see the fixed rate on it's 2.4% on this product. I know of a couple producers that really do promote this as an alternative to a MYGA because of the fixed rate. Right now, there may be higher MYGA rates than 2.4%, but it's a 7-year product with a 2.4% fixed rate. It's a way to get them into the index, but keep them in the fixed account. So you could put a client in this at that fixed account at 2.4, and then next year at renewal, maybe they're willing at that point to move a little bit into the market, into the S&P 500 or into the Mark V or the Barclays. All right, so it's kind of a way to get them the MYGA type product, but give them a lot more options down the road from a reallocation standpoint. So we are seeing a little bit of that. You can see the rates are strong on it with 4.25 point to point. We got 85 on the Focus 50 1 year, 115 on a 2-year. We're looking at illustrated rates of over 7.5 on the 2-year here. So once again, very strong rates, very similar to the market value, except a 7-year version of it. So to summarize the products quickly, first off, EquiTrust is always about trying to keep things simple. So we have very simple products, very simple procedures, really good support, I think, internally from a new business standpoint and a sales standpoint. We have one of the few carriers that has a no-fee return of premium product, which is approved in almost all states. Talked about the true 10% upfront bonus product, no vesting. The area we're really seeing now is the accumulation-focused products with the market value and the market 7 in combination with the Mark V and the Barclays strategies. We talked about this strong renewal rate history, transparent. We have a lot of longevity with our products, take a lot of pride in our renewal rate integrity. And last is competitive commissions. I don't think I mentioned this, but on 3 of our 4 index annuities, we do not reduce commission at older ages. So it's full commission to the maximum issue age on all the products except for the market 7. Okay, what I want to do for the last few minutes here is talk about a couple client point of sale pieces we have that I know producers are having success with, and then one what I think is a pretty unique sales idea. First off, the ladder performance. This isn't a piece. This is just a kind of a strategy, and one you guys may be familiar with. We've talked a lot about the Barclays 2-year, talked about the Mark 5. One of the issues with the 2-year strategy, obviously, is that the client doesn't see growth for 2 years, right? So if they put money in there, it's going to be 2 years before they see any growth in it. And that can be a problem in the annual review where obviously clients want to see something every year, especially if the markets are up. So just a strategy for that is to maybe have them put half their money in a 1-year strategy, like the Mark 5 1 year, like we talked about, and then half the money in a 2-year strategy, like the Barclays 2-year, right? Then at the end of the first year, the client will get a statement and hopefully we'll see some growth on half their money in the 1-year strategy. And at that point, they can reallocate their money to its own 2-year strategy. Okay, so at the end of the first year, now what you have going forward is you have alternating 2-year strategies. So the client's getting the benefit of the most potential with a 2-year strategy with the higher participation rates, but they're also presumably seeing growth every year if there's returns on it. So just a kind of an easy strategy to put them at ease with not getting a statement every year that shows growth. Let's take a look at just a couple client pieces, point of sale pieces. This is one I'm sure you've all seen before with other carriers. You know, we're not the only one to have something like this, but a very popular piece. I think it really shows the value of annual reset and locking in your gains, right? The red line there represents the S&P 500. The blue line represents the index annuity over the last 20 years. And I think it really shows the value of locking in gains every year. And if you look at this, I mean, you take a look at the S&P there, you see a couple big drops, right? I mean, those are 40% drops. So I think it's a great piece just to kind of illustrate that to the client. Along with that, there's another piece I think is important to show too, and that's this one, which shows, you know, what it shows is the return needed to recover from a market loss, right? And I know you guys are all familiar with this, but I also know clients many times are not. You know, they think if they go down 10%, you know, in their investment that they're in, then they need to get 10% to get it back, or in fact, they need to get 11.1% to get it back. So just a nice little chart that shows them that. I mentioned on the previous piece that it shows like 2 dips of 40%. Well, if they have a 40% dip, they're going to need to get 66.7% to get back to square one on that. So I think the two pieces kind of go hand in hand together when talking about retirement with a client. Okay, and then my sales idea. Okay, I want to preface this first off by saying this really is very conceptual. Okay, what I mean by that is I don't have any supporting documentation I can send you. So we're really talking about just kind of an idea here because I don't have like an illustration or a marketing piece on this. It's just kind of an idea I'd come up with it, you know, a year or so ago. And to help you when dealing with a client who wants to do a Roth conversion, but doesn't want to come up with the money to pay the taxes, right? I mean, Roth conversions make a lot of sense, especially now. I mean, people think interest rates will go up, tax rates will go up. So, you know, very much could make sense to do a Roth conversion. But the bad part or the hard part about it is how do they come up with the money to pay for it, right? So here's a potential solution to that. So we're going to take a $250,000 IRA and we're going to split the money. Okay, we're going to put $70,697 of it into a market value index IRA. That's the growth product we talked about. We're going to put the rest of it, $179,000 and some change, into the market power bonus, which is our 10% bonus product. Okay, we split about 72%, 28%. Then what they're going to do is we're going to take that market value index IRA and we're going to convert it to a Roth. Okay, which you can do at any time with EquiTrust. We're going to assume the client is in a 22% tax rate, so the taxes due to them next year is going to be $15,553, right? That's the money they have to come up with to pay those taxes. Now, on the other side, the market power is still in an IRA. We're not converting it to a Roth. Okay, we're going to give them the 10% bonus immediately, and for the sake of guarantees, we're going to put them in the fixed account, right? It's just 1.1%. You could obviously get a lot more by going in the index, but I want to show guarantees here. So they get the 10% bonus, they get the 1.1% fixed rate. So at the end of the first year, their account value in the market power bonus is $199,403. after the first year, right? So the first year, 1 year and 1 day, we're going to have them take out a free withdrawal. They can do 10%. So they take out a free withdrawal is going to work out to $19,940. Okay, so they have $15,553 taxes due. They just took out a withdrawal for $19,940. Why do they take out more? Well, they took out more because there's going to be taxes on the free withdrawal. So we did a gross withdrawal of $19,940, which resulted in a net withdrawal of $15,553, which happens to be the exact amount they owe for taxes on the Roth conversion. Okay, now I'm not going to get into a lot of detail on this, but there is a timing aspect to all of this, so I should mention that. So once they do that, at the end of let me go to the next screen. So basically, after they do all that, after they take out the withdrawal, pay the taxes on the Roth conversion, they're going to have a market value index worth $75,208. And I use the Barclays 2-year strategy on this from an illustrated rate perspective. They're going to have a market power bonus of 179,462. So this is 1 year and 1 week later after issue or whatever. So the total amount now is $254,670. So a little over a year after they issued it, they're still going to have $4,000 more than they put into it, but they're going to have converted 75,000 of it into Roth, and client paid nothing out of their pocket. So the idea is they're using the free withdrawal of the premium bonus, basically from the market power bonus, to pay the taxes on the conversion of the market value index Roth. I know it can be a little complicated and a little confusing. Now, I do want to back up and mention once again, it's a sales idea, sales concept. I don't have supporting documentation. There's no flyer I can send you. There's no illustration. I can't run the numbers. I just kind of figured them out on my own and through a spreadsheet. But I still think it's worthwhile to talk about the idea. When you run into a situation where a client wants to do a Roth and they're trying to figure out a way to cover the taxes, this is an idea. Okay. With that, that's all I have. I appreciate your time. I appreciate your support of EquiTrust and your business with EquiTrust. Let me pass it back to Matt to see if there's any questions or anything he wants to add.
Well, I appreciate the information this morning, Jason. I know that we've seen a nice block of business going to EquiTrust this year. How much is your business up in 2021?
That's a good question. We're up quite a bit. We're basically on a similar run rate as we were to last year. Last year was like our third biggest year ever, believe it or not, in the pandemic.
Okay. Right.
We had a huge year last year. So we're on a similar run rate to that, but we're up year over year. We're up quite a bit from where we were at this point last year. I don't know the exact numbers, Matt, but
right.
Yeah.
Yeah, it's good. I mean, it's obviously good to see the annuity space growing, and we see a big increase in our production this year also based on what's coming through IMS. And yep. I know EquiTrust is a big block of that. And really, I mean, I know you guys are looking at possibly doing some stretch stuff here down the road. Is that
yep.
still the plan?
Yep, that's in the, I don't have any times to give you on that when it needs to be done, but we have lots of different things we're working on. We have a couple new products we're working on, just some service-related stuff to make doing business with us easier that we're working on. So there's lots of stuff going on, and lots of different things we'll be rolling out yet this year. So keep your eyes, including stretch. So keep your eyes open for that.
Well, good. Yeah, we'll look forward to that. And I know you guys are RMD friendly. If you got someone that's got some qualified monies they want to put into EquiTrust, I know you guys are friendly on that side. Yep. And with some of the the bonus rates and then the pure accumulation sides, you guys have all the bases covered. And then, as we see, probably we'll see some of the interest rates start climbing on the fixed side, and we're going to see you guys become more competitive on that end too with the certain select contracts. So I know EquiTrust is really, yeah.
Sorry, I didn't mention SPIA either, but we're typically pretty competitive on the SPIA side, especially on the period certains. And the other thing we do with SPIAs is we pay full commission even for a 5-year period certain. We still pay 3% commission, which is unique, and we're typically in the top 3 or 4 as far as payouts. So, and I always encourage you to quote us on SPIAs because we're typically going to show very well on that. Plus, we pay the producer well. So,
now, do you guys go maximum issue age 90 on those? Is that what you guys typically do on the SPIAs?
On the SPIA, I should know that. I believe so. No, we go 85. Sorry.
85. Okay. 85.
Oh no,
okay.
No. I'm sorry, man. We go 90 on the fixed. If it's a period certain, we go 90.
Yeah. So
if it's a life option, we go 85.
Right. So if you got someone that's looking for a 5-year fixed on a 90-year-old, EquiTrust is definitely the way to go based on the compensation and the payouts. I mean, they're really strong in the SPIAs, and we send a number of SPIAs to them every month. So definitely
And we
a
will
great combination there.
Yeah, sorry to interrupt, Matt, but yeah, and we do, if you're using SPIAs to fund life policies, like a lot of people do at different carriers, we will send the money to a life insurance carrier to fund a life policy. So we have a form you can complete to do that. So if somebody's doing that where they're, 10 paying a life policy with a SPIA, we're able to accommodate that.
Mm-hmm. And then if you do have an individual that wants to set up a systematic withdrawal on a lot of your policies, you can start that in the second year. And that way the client gets money's coming out to them every month. And that really helps with supplementing Social Security at this point.
Yeah. Yes.
Well, anything you want to finish up on here before we interrupt today here, Jason?
I don't think so. I just appreciate everybody's time and looking forward to a little better year and maybe getting out of the house some.
There you go. Get back to the
doing
office
some things,
eventually.
So get back to the office, and no, I think it's going to be a great year. We're off to a great start. Appreciate everybody's business and support of EquiTrust.
You got it.
And you guys, especially Matt. I appreciate all you guys over times.
Oh, definitely, and appreciate your time this morning, and appreciate everybody joining us today. Everybody have a great Memorial Day weekend coming up. A little bit different than last year, so we can get out and enjoy some outdoor activities and take those masks off eventually. Otherwise, everyone have a great week, and we'll talk to you soon. Bye now.
Thank you.